Good morning, everyone. I hope you're doing well. It is Thursday, June 6th. Crazy to think it's already June. It's been a while since I've done a Monday Not Math Retirement Coffee Talk, so I hope everyone's doing well and enjoys today's conversation. Apologies for having a couple little minute late start here. Just kind of getting everything booted up on my computer. As always, if you have questions or comments, please leave them in the comments section so that I can answer them or respond to them. It is my goal to provide as much value as I can on these, so I would much prefer to be answering your questions rather than just coming up with things that I think might be interesting to you. So if you have questions or thoughts, please leave them here in the comments section. Like I said, I would love to spend an hour answering those questions. If there are an hour's worth of questions, I'm happy to stay on for an hour. If there's not, I'll probably wrap it up around 9 o'clock here, so in about 23 to 30 minutes. So with that, I will give a moment to see if anyone has any questions for us to start out with. All right, while we're waiting, I will give my disclaimer. Weekly retirement planning coffee talks are an informal way for me to have conversations and answer questions with people, even if they are not my clients, for free. You are welcome to join the Facebook Live, which I'm on, or stop by my office for free coffee, which is downtown Thief River Falls, across from Styles by Amy in the same building as the Sarah Jane Boutique, until the end of July. By the end of July, I will be moving my office to the ODC building out by Sanford into Suite B. So with knowing that, just let me know if you want to stop by in person for this conversation or in a future planning conversation. I may be here or I may be there, so make sure you reach out ahead of time so we can make sure we coordinate the right destination, or I can meet online, which I do with a lot of people. There is no pressure to work with me or become my client by stopping by in person or online. I always love to answer questions and give away a little bit of free information before people become my clients, so we can decide if it's a good fit, or in a case like this, it's completely just to give away free information because I love what I do and I love making a positive impact in people's lives. It is my mission to provide the highest quality advice and service possible to my clients. Therefore, I limit myself to only having 100 or less active clients at all times that I have a fiduciary responsibility to. Even though I limit myself to only working with 100 clients at any given time, it is still important to me to provide as much value as I can to as many good people as possible, which is why these conversations are so important to me. Disclaimer: this content is not legal, tax, or investment advice. You should always consult a qualified professional regarding your personal situation, which I am on the investment side, but unless we sign a contract, this is just purely a conversation. It is not me giving you direct individualized advice. It's hopefully just valuable information. So, and this is live, so I may make a mistake from time to time. Please don't hold it against me. I look forward to some great conversations and hope you have a wonderful day, whether you're watching this live or at a later date. You can listen to it on my podcast or watch it on my other platforms. I will do my best to download it and share it in other places. With that, are there any questions to start? Like I mentioned, please put them in the comments section below or at any time during this live video. I have 1 hour set aside on my calendar to answer questions, but if there are not enough to take up an hour, I'll wrap this up in about 30 minutes. Give you guys some time to think about it. Hopefully there's some questions that come up here off the bat. I don't believe I saw any questions on any of my posts beforehand, so unless I get some, I will just look for some interesting articles and hopefully provide some value. This is all about you guys, though, so please let me know what you're thinking. All right, so I don't see any questions yet, so the first article that I'm going to cover, I actually posted about it a couple of days ago, but I wanted to conceptualize it a little further today. I think it's an extremely impactful thought because there's a lot, we're kind of in a DIY generation. There's nothing wrong with that. If you love doing your own planning, if you love doing your own investments, and you're doing a decent job at it, by all means, that's your choice. I'm just simply here to help those who want to work with a team, and maybe I'm biased, but I think it's extremely valuable to have an advisor and have a team built around you. Whether I work with a CPA, a lawyer. I talk to my business partner about my own financial decisions because anytime my emotions are tied up in my decisions, it's possible they get manipulated by emotion rather than logic. So I think having a team is really important, and I always ask people, like, name a professional athlete who doesn't have a team around them, right? Almost every golfer has a swing coach and a caddy. Any other professional player has coaches and trainers and all this thing. It's because it's so much help to get someone else's perspective on our situation. So here's the article. It's by smartasset.com, and it says the true cost of a financial advisor revealed. I'll put it here in the comment section in case anyone would like to read it themselves. All right, here it is. So June 2024, in a society where people turned, and this is written, it doesn't say who's written by, maybe probably at the end. So in a society where people turn to social media for help deciding between paint colors, it's unthinkable that so many of us continue to entrust our financial future to ourselves. According to a Fidelity study, which is quoted in the article, financial advice can add between 1.5% and 4% to account growth over extended periods. That's pretty big. That's pretty big. So you basically take the growth you would have gotten and you just stack it on top. So what does that mean? Let's just put together a quick finance. This is not in the article. I'm just putting this together on the fly. So let's say you're 50 years old, 55 years old, getting ready to enter your retirement in the next 5, 10, 15 years, and the human life expectancy is about 87-ish. So let's just say you have a 30-year retirement. If you have, let's say, $500,000 in your retirement, or we can do a little bit lower number. So let's say you have $300,000 in your retirement account for 30 years because you want it not to run out when you're in retirement, right? You want it to last throughout retirement. Obviously, you'd be spending this down, but we don't want to get too complex. Let's say you would have received a 5% return on your own on that $300,000 over 30 years. Your $300,000 over a 30-year period receiving a 5% return would have grown to about $1.3 million. All right, 300,000 to 1.3 at 5% return. Now, if the study is correct and true, and you were able to add somewhere between 1.5 to 4% growth on that money by working with an advisor, that 1.3 million at 6.5% return over 30 years goes to almost $2 million. That's a $700,000 increase at minimum. That's the 1.5% number. Now, 5% was almost 1.3 million. 6.5% is almost 2 million. What if you're able to get to 9%? What if you're 5%, you're able to get up to 9% by working with a financial advisor? Your 300,000 over 30 years at 9% return is now almost $4 million. That's 1.3 to almost 4 million. That's a $2.7 million difference by adding 4% over a 30-year period. That's a massive difference. So oftentimes people can get caught up in thinking, well, 1.5 to 4%, that's not that big of a difference, is it? Well, when you stack compounding over a long period of time, that can make a pretty significant difference. So hopefully that's an impactful example that shows the true cost of a financial advisor. And continuing on with the article, it says, so why do some Americans continue to walk the financial road alone? For some, the excuse is false assumption that they can't afford it. In actuality, the fees financial advisors charge can potentially be less than most people think, and the insights they add could potentially surpass an advisor's cost. The truth is, financial advisors often charge a percentage fee for assets under management of between 0.59 to 1.18%. A 2021 Advisory HQ study found that the average AUM fee for a $50,000 account was about 1.8% or $590. And the way that works is that if I'm managing your money, you don't write me a check. The percentage of that money comes out of the assets that we're managing. So if your value of your assets goes up, the amount that you pay us goes up because it's a percentage. But if the value of your assets goes down, the percentage you pay me goes down. So not only are we fiduciary and legally responsible to do what's in your best interest, it's also an incentive for us to do the best we can for you, right? We're not paid the same amount no matter how poorly or how great we do for you. Our income when we're having a percentage of assets under management is a direct correlation to your success, and it's not coming out of your checking account, so you don't really necessarily feel that burden on a day-to-day, week-to-week, month-to-month basis. It's tied in within the account that we're managing. So if you can go from 1.3 to almost 2 million or 1.3 to almost 4 million paying about 1% of the assets that we're managing. Is that worth it? Average financial fees. Common fee types and costs. Percentage of assets under management. So they're talking about different graded fees. So they have percentage of assets under management of 0.59 to 1.18% per year. We don't mess around with different grading levels. We just charge 1% across the board unless there's a legacy example in play or you have a prior example, or it just kind of makes sense. So there are one-offs or situations where we don't charge one, but generally speaking, we just try to keep it simple and easy for our clients. Fixed fees. Some people charge a fixed fee of $7,500 for portfolios under $500,000. So that'd be like I'm managing your $500,000. You just pay me a flat rate. We don't really do that a whole lot either. We typically stick to the 1% of assets under management. And there's also hourly fees of $120 to $300 per hour. That is done sometimes either on a project basis or an ongoing basis. The figures above are examples only and used to illustrate what typical fees for financial advisors and their structure looks like. Please carefully review the fee structures with an investment advisor and review your advisor's Form ADV and CRS. So we all have disclaimers. I don't know how many people actually read through them all the way, but we definitely want our clients to understand what that means. I'll just put a question here in the chat. See if anyone is interested in answering it and providing their opinion. All right, so I just put those numbers in the chat. I would love to hear your guys' opinion. Those are all rounded numbers. Those are not guaranteed numbers. Like I said, this is a hypothetical example. But hopefully it prompts some conversation from those in the comments. All right, continuing on. This says, why speak with a financial advisor? Consulting a fiduciary financial advisor could help you determine a plan that factors your assets and taxes into your overall retirement and estate planning goals. Fiduciaries are obligated by law to act in your best interest, and any potential conflicts of interest must be disclosed. Yet knowing how to find a vetted fiduciary advisor is, for many, the most confusing task of all. Common Google searches related to the topic reveal a desperate search for direction. Fiduciary financial advisors near me, best fiduciary financial advisor, and yada 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 are searched hundreds of times per day. Finding a fiduciary shouldn't be that hard. Thankfully, now it isn't. So they go on to sell one of their products. And again, a general difference between a fiduciary and non-fiduciary. If someone's a fiduciary financial advisor, their responsibility is to do what's in your best interest. If they aren't, their responsibility is to sell you a product. So as long as they educate you about said product, it doesn't really matter if it's actually like the best thing for you, as long as they told you how it worked and they didn't lie about that. So hopefully that brings up some questions. Let me know what you think in the chat. If not, I will move on to another article that is hopefully of some value. All right, so this one is a recent email news article that Ross sent out to our clients and some other people who follow us. And it says where money know and how it goes off the rails. So that's not really a great description, but what it says is, where do you turn when you need a fast answer about finance? I'm talking minutes or just 60 seconds. Did social media come to mind? Though not uncommon, it is not necessarily the best solution. Social media can be a wonderful place to make connections, share photos, and find inspiration. That does not make it the right place to glean market facts or advice on navigating your personal finances. Why? Loading. Truth versus trend. The dangers of social media influencers, or finfluencers. What's the hottest financial tip or trade secret you've ever seen on social media recently? What about retirement hacks, crypto offers, or cutting-edge investing advice? If you're a social media user, like most, the financial expert chatter is almost inescapable. That's a hard word to say. So-called finfluencers are on nearly every social platform. They tend to offer shortcuts and make grand promises and claims that seem too good to be true. Yet many of us buy in without hesitation. More than ever, we're using social media to learn about money matters. But that's risky and not the best way to receive balanced financial support and factual advice that is tailored for our unique lives. Keep scrolling to learn why social media and financial planning do not mix. So I know you're not scrolling, but hopefully you can follow along. I'm reading clearly enough. Three big risks when using social media for financial guidance. Number one, believing the bad hype. Blindly buying in what's popular, commonly referred to as herd mentality, involves following the masses without thinking twice or making conscious decisions. This mob behavior can run rampant on social media. It can also be easier to fall victim to when we have FOMO, or fear of missing out, or when we rely on mental shortcuts. Example, remember the GameStop debacle? Their stock shot up wildly in value in January 2021, and behind the roughly 20x rise in this stock's price was herd mentality, mostly drummed up on Reddit and facilitated by the New Age stock trading platform. After several investors got in on the action, the price of GameStop took a nosedive. Many individual investors and hedge funds lost big. So that's an example of herd mentality and following a pack, but if you got in late, you lost a lot of money. Also, another valuable reminder of it's important when it comes to stock investing, if you can, to buy low and sell high, not buy high. So just because everyone else is doing something and the price is shooting up, that's not necessarily a great time to jump on the bandwagon. Risk number two, idolizing an illusion. Misinformation is not new to social media, but under the guise of advice from a wealthy influencer, it can be much harder to spot. Sponsored posts from high-profile celebrities in finance or business can be even more persuasive, causing a rush to emulate what likely isn't real or attainable. And many of us mistake high-volume shares, followers, and likes as evidence of distinction and integrity. Example, a few years ago, a well-known influencer with over 800,000 followers made nearly $190,000 after charging almost $500 per student for a 12-week course on how to build your own travel blogging business. Once the course began, frustrations started trickling in, stating that the content wasn't as advertised. The influencer then blocked those who complained, leaving most students at a loss. It's unclear if any money was refunded. Risk number three, sinking inside a scheme. Get rich quick, GRQ, schemes promise fast, unrealistic returns if you invest, sign up, become a member, and/or act now. GRQ schemes seldom talk about risks. It's all about rewards. And you're usually required to pony up a generous amount of cash or refer others to get started. The truth? Most GRQ schemes are a house of cards, conning the people who sign up and almost never making them rich. Instead, they likely end up losing their shirts. Example, multi-level marketing schemes are all over social media. Work from home, or make $100,000 in your first month, or be your own boss are some of their common promises. Most participants lose money in these schemes, and the few who find success typically have to invest and hustle for years, which could have been the timeline for launching a successful non-MLM business. Now, I want to put a caveat on that just to make sure we're clear. I know some very successful people who work in multi-level marketing, and I'm not saying there's anything wrong with it. Generally speaking, every company is kind of like a pyramid scheme per se. The owner of a bank makes a lot more than the executives, who makes a lot more than the people who work underneath them, who makes a lot more than the salesman, who makes a lot more than the receptionist, right? So it's just the same thing as Walmart and everything else. But be very clear in understanding how you're getting paid and what you're getting paid for if you're going to enter a business where they claim you're your own boss, but really you're forced to do what they want you to do. All right, so there's no way social media can advise or guide you on a personal level. All right, so that's an invaluable reminder. Any questions or thoughts on that one? Seeing none. I don't want to read about stocks and bond correlations. All right, this is pretty in the All right. Take it from Warren Buffett. Misses are inevitable. All right. So this is on Morningstar.com, written by Danny Noonan. And again, that title is Take It from Warren Buffett. Misses are inevitable. This will probably be the last article I read unless I start getting some questions from the audience or comments that you'd like me to address. All right, embrace these timeless investing principles and you can still attain remarkable outcomes. This was wrote on May 13, 2024. Woodstock for Capitalists takes place the first Saturday in May. That's a reference to the Berkshire Hathaway annual shareholders meeting. More than 30,000 people fill an arena in downtown Omaha, standing room only, seeking updates and general investment wisdom from Warren Buffett. The weekend of the event, hotel rooms at the Hilton Omaha across the street from the meeting venue were fetching $2,500 per night, and it's a 2-night minimum, meaning $6,000 after taxes for the weekend stay. Wow, I hope they're getting some really good value. Put simply, demand is high. The reason is obvious. Buffett and Berkshire have nearly a 60-year track record of delivering consistent results. According to Barron's, Berkshire's shares could fall 99% and remain ahead of the S&P 500 total return since 1965 when Buffett took over. Berkshire's total returns work out to a cumulative gain of more than 4,000%. The S&P 500 returned more than 31,000% in the same span. But when you compare the returns side by side, it appears the S&P 500 returned nothing. That's how outstanding Berkshire's long-time track record has been. But a funny truth about Buffett, he's often more inclined to discuss mistakes rather than celebrate success. As one example, the 2018 Berkshire annual meeting had a question from a shareholder who asked, "You have gotten into the tech world purchasing Apple. You have Bill Gates sitting in the front row today. I'm just wondering why you've never bought Microsoft." Laughter broke out as Gates, then a Berkshire board member, smiled while sitting in a folding chair near the stage where Buffett was answering questions. With the usual candor, Buffett remarked, "It's very clear. The answer is stupidity." Buffett and Gates have known each other since at least 1991, when they initially met. Microsoft was a publicly traded company valued around $10 billion. Today, Microsoft is worth nearly $3 trillion. More than 44,000% return left on the table, a giant miss. How did missing Microsoft impact Buffett or Berkshire shareholders? Probably not at all. Buffett's average aversion to technology stocks has been well documented. If he bought Microsoft in 1991, it's not obvious he would have held it for 30 years. That was a period when the business went through multiple transformations, starting in computer software, moving into video game manufacturing, and then an aggressive expansion into cloud computing. Buffett was a fan of betting on horses at an early age, detailed in Alice Schroeder's book, The Snowball, and enjoyed the process of handicapping, only placing wagers when he believed the odds favored him. In the case of Microsoft, he didn't believe the business moat, one that would protect Microsoft from competition, was strong enough. But he did identify moats across Geico, American Express, Coca-Cola, Gillette, and countless others where he believed the odds were advantageous, and he felt more comfortable about the future for each. It's easy to think Microsoft was a miss, but the opportunity cost is unknowable. Buying Microsoft could have taken his attention away from the many other businesses that delivered great investment outcomes in the decades that followed. What a great lesson that is. If we focus and dwell way too much on our misses and our mistakes, we might miss out on the next opportunity. Buffett finished answering the question stating, "We missed a lot in the past, and I suspect we'll miss a lot more in the future. If one of the world's great investors can brush off perceived miss, maybe the rest of us should too. Whether it be Nvidia, Bitcoin, or any other shiny object, getting a few simple things right over an investment lifetime and less emphasis on home run hitting will carry most of the freight. For many, the simple things, while not all-encompassing, can be distilled down to a few key ideas. Save more than you spend, diversify across asset classes, invest regularly, even during bear markets and corrections, be mindful of costs, don't panic during sell-offs. Recognizing the impossibility of participating in every winning investment is crucial, a principle even Buffett acknowledges. By prioritizing timeless investing principles and embracing simplicity whenever feasible, investors can still attain remarkable outcomes." All right, so some pretty good advice there and some great examples of not dwelling on mistakes, but also recognize that we're going to make them, right? No one's perfect, whether it's me or anyone else that you work with. The market's going to have its swings. We're going to make mistakes. We're going to learn new things, just like everyone else. Doing things perfectly and living a perfect life is not realistic. So With that, any questions, comments, concerns, or remarks regarding anything I talked about today or anything I didn't? I'd be happy to stay on for another 30 minutes if there are questions or thoughts. If not, I will probably wrap this up in about the next 60 seconds. All right, so I'm not seeing any questions or thoughts. So with that, I would just like to say I hope everyone has a wonderful day. I hope at least where we live, things start drying up a little bit. I don't think we need any more rain for a little while, but maybe I'm wrong. Someone out there really wants it. I'm not sure. Either way, we're all grateful to be happy and healthy. I hope everyone has a wonderful day and has a wonderful rest of their week. Thank you so much for taking the time to come and join me live today, and for taking the time to watch or listen to this recording at a later time. If you do enjoy it, please share, comment, and or like it so that other people can enjoy it as well. I'd really appreciate the help in providing more value to more people. If you have questions or thoughts or requests for future Money Not Math or retirement planning conversations, please put them in the comments section at any time or reach out to me via Facebook or email. I would really enjoy having those conversations, and I hope everyone has a wonderful day. And last but not least, I think I forgot, if you'd like to... Yes, if you want to join our newsletter, just reach out to me. I'll put my email in the chat here, and I'll get you on there. I covered one of our newsletter. It can be some really good, valuable, free information. So with that, I hope everyone has a wonderful day, and I'll talk to you later. Bye.